Okay, so let me ask you something. You're watching the news, right? Layoffs everywhere. Stock market tanking. Your boss just sent that email about tightening our belts. And what's your immediate reaction? You panic. You stop spending. You hold on to every dollar like your life depends on it. Maybe you even pull money out of your investments because, look, who wants to watch their money disappear? Meanwhile, somewhere across town, there's someone who's excited about all this. They're not panicking. They're actually shopping, making moves. And 5 years later, they're significantly wealthier, and you're still trying to get back to where you were. How does that make any sense?
My name is Bill, and I spend way too much time thinking about why financial crises make rich people richer while everyone else gets poorer. If you're someone who's watching your peers somehow come out of economic downturns better off than they went in while you're just trying to survive, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because here's the thing, recessions don't create wealth inequality, they reveal it. They expose the gap between people who understand how money actually works and people who are running on financial autopilot.
When recession hits, poor people and rich people do opposite things with their money. Let's say the economy starts tanking tomorrow. Stock market drops 30%. Companies announcing layoffs. The average person, John, making $60,000 a year with $15,000 in savings, his immediate reaction is fear. He stops all unnecessary spending, holds on to cash, maybe pulls money out of the stock market, and goes into full survival mode. Now let's look at someone wealthy, Sarah, with $2 million net worth. The same recession hits, she evaluates which assets are now undervalued, accelerates her investment purchases, looks for distressed properties, and goes into full acquisition mode.
Now, you might be thinking, well, yeah, of course Sarah can do that. She's already rich. But here's what most people don't realize. The difference isn't just about having money. It's about their entire mental framework for what money is and how it works. Most people think wealth is about having a lot of money in the bank. But here's the thing wealthy people understand that poor people don't. Cash is actually the worst place to store wealth during a recession. Let me show you with real numbers. During the 2008 financial crisis, you had $100,000. Two choices. Option 1, keep it in savings. You earn maybe 1 to 2% interest. Meanwhile, inflation runs at 3% annually. That $100,000 in 2008 would need to be $141,000 in 2023 just to have the same buying power. You basically made nothing after inflation. Option 2, buy assets during the crash. You bought stocks in March 2009 when the S&P 500 was at 676 points. By 2023, it hit 4,500 points, a 565% increase. Your $100,000 would be worth approximately $665,000. Same time period, same money. One strategy made you $665,000, the other made you basically nothing. That's a difference of over $500,000. But Bill, that's hindsight. Nobody knew the market would recover. Here's what you're missing. The market always recovers. Every single recession in U.S. history, the market has eventually come back and exceeded its previous highs. The S&P 500 has averaged 10% returns over the past century, including every recession, depression, and crisis. But most people can't think this way because they're operating on emotion instead of data. Here's why your brain is literally programmed to make you poor during recessions. Human beings have something called loss aversion. Studies show that the psychological pain of losing $100 is about twice as strong as the pleasure of gaining $100. During a recession, when you see your investments dropping, your brain screams, "Danger! Get out now!" This instinct kept your ancestors alive when they heard rustling in the bushes, but it's devastating for your finances. During 2008, individual investors pulled $234 billion out of stock mutual funds. They sold at the bottom. Then they didn't start buying again until 2013, after the market had already recovered. They sold low and bought high, the exact opposite of what you're supposed to do. Meanwhile, what were wealthy investors doing? The top 1% of wealth holders increased their stock holdings during 2008 to 2009. They bought when everyone else was selling. This is why recessions make the wealthy wealthier, Not because of some conspiracy, it's because wealthy people have the financial education and emotional discipline to act opposite to their instincts. Let me tell you about what I call the asset acquisition window, the period during and right after a recession when assets are significantly undervalued. During the 2020 COVID crash, airline stocks dropped 60 to 70%. If you understood that people would eventually fly again, you could have bought Delta stock at $20 and sold it 2 years later at $40. That's a 100% return. During 2008 to 2009, rental properties were selling at 30 to 40% discounts. If you bought them and rented them out, your returns jumped significantly. But here's the crucial part. This window is temporary. It typically lasts 12 to 24 months. Once the economy starts recovering, the opportunity is gone. Wealthy people understand this window. They prepare for it. They position themselves to take advantage of it. Poor people don't even know it exists. They're too busy panicking to realize that recessions are actually the best time to build wealth. Here's another massive difference: income diversification. John has one income source, his $60,000 job. If he loses it during a recession, his income drops to zero immediately. He's now living off savings while desperately job hunting in the worst market possible. This is terrifying. Sarah has multiple income sources: a business generating $100,000 per year, 3 rental properties generating $50,000 per year, dividend stocks generating $20,000 per year. When a recession hits, maybe her business drops 40% to $60,000. Rentals drop to $45,000. Dividends to $15,000. Her total income is now $120,000, a 29% drop. It hurts, but she's not in panic mode. She can still think clearly and make strategic decisions. John is unemployed and burning through savings with zero income and increasing desperation. And here's the kicker: Sarah built those income streams before the recession. You can't build them during the crisis. You build them now so you're ready when it hits. Let me show you what missing one recession opportunity actually costs you. 2 people, both 30 years old, both have $50,000 saved. Person A, conservative approach, keeps $50,000 in savings during 2008, doesn't invest. Over the next 30 years, gradually invests $5,000 per year during normal times. By age 60, about $750,000. Person B, opportunistic approach, invests that $50,000 in March 2009 at the bottom. It triples to $150,000 in 5 years, then invests $5,000 per year like Person A for 25 years. By age 60, about $1.4 million. Same starting amount, same yearly contributions. Person B has almost twice as much because they took advantage of one recession. Missing that one opportunity cost Person A $650,000. Now, multiply that by 5 to 7 recessions over your lifetime, and you understand why the wealth gap is so massive. So, what do you actually do with this information? Step 1. Build a 3 to 6 month emergency fund. Not more, not less. If your expenses are $3,000 per month, you need $9,000 to $18,000 in savings. Everything else should be invested. Step 2. Educate yourself now. Don't wait for the recession. Learn about index funds, dividend stocks, real estate basics. When the crash comes, you need to already understand what you're buying. Step 3. Create your recession shopping list. Write down specific assets you'll buy when prices drop. I'll buy VTI if it drops below X dollars. This removes emotion from the equation. Step 4. Automate your investing. Set up automatic investments into index funds. During recessions, you'll automatically buy more shares when prices are low. This is dollar cost averaging. Step 5. Start building a second income stream. Even $500 per month from a side business or dividend stocks teaches you the mindset of income-generating assets. Look, here's the reality. Most people won't do any of this. They'll watch this video, nod along, think, yeah, that makes sense, and then do nothing. When the next recession hits, they'll do exactly what they did last time: panic, sell investments, hoard cash, and miss the opportunity. What separates people who build wealth from people who don't isn't perfection, it's action. The person who buys $100 of dividend stocks during a recession is infinitely better off than the person who does nothing. You don't need to be perfect. You just need to make better decisions than you made before.
Another recession is coming. Could be next year, could be in 5 years, but it's coming. You have a choice. Do what 95% of people do and panic, or do what the top 5% do and get wealthier. But here's the thing. You can't make that choice during the recession. The fear will be too strong. You have to decide now. Decide today. When the next recession comes, I'm going to be one of the people who gets wealthier. Then prepare. Build your emergency fund. Educate yourself. Create your plan. Take action. The next recession will either be the worst financial event of your life or the best opportunity of your life. That choice is determined by what you do today. Why do the wealthy get richer during recessions? 3 principles. Number 1, assets over cash. Wealth is stored in assets that generate income and appreciate. During recessions, assets go on sale. Number 2, long-term over short-term. Wealthy people think in decades. They tolerate short-term volatility for long-term gains. Number 3, data over emotion. They make decisions based on historical data, not fear. And here's the beautiful thing. You can adopt these principles today. You don't need to be wealthy to think like wealthy people. The best time to start was 20 years ago. The second best time is today. Start small. Start with whatever you have, but start. When the next recession comes, I want you to be one of the people who comes out wealthier, not poorer. If this helped you, hit that subscribe button and thumbs up. I'll see you in the next video where we'll dive into specific investment strategies. Until then, start preparing. The next recession is your opportunity. Don't waste it.